Ladies and gentlemen, good day and welcome to the Q3FY22 Earnings Conference Call of SIS Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devis Desai, Group CFO. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. Welcome to our Q3 FY22 Earnings Conference Call. Along with me, I have our Group Managing Director, Mr. Rituraj Sinha. I hope everyone has had an opportunity to look at our results. The presentation has been uploaded on the stock exchange and on the company website www.sisindia.com. We are extremely happy to report one of the strongest ever quarters of growth for SIS, with consolidated revenues touching a historic high of rupees 2,601 crores during the quarter. This effectively translates to an annualized revenue run rate in excess of 10,000 crores. Our consolidated revenue was up 10.3% year-on-year and 7% over the last quarter. All businesses across the group reported strong revenue growth, and almost all of them crossed their pre-COVID levels during the quarter. At rupees 130 crores, reported EBITDA was at 5%, whereas pro forma EBITDA was 5.4% after removing the impact of additional expenses during the quarter, and which included certain one-off expenses. Details have been provided in the earnings note, which was released as part of the stock exchange upload. Operating PAT for the quarter was 76.7 crores, again, which is the highest ever. On a YTD basis, OCF to EBITDA was 31.6%, which was driven mainly by the revenue growth during the year to date. A strong order book and new wins during the quarter for all businesses have set us up strongly for both the next quarter and the year across the group. The cash logistics segment continues its steady revenue growth, with all service lines performing well and EBITDA and EBIT steadily moving up, coupled with strong cash accruals. In fact, this was the only business in the group which sustained its revenue and financial performance throughout the COVID period over the last 2 years. It also has a strong pipeline of orders and deployment. This is one business segment which was till now not ascribed its true value, and we trust this will change. We also released our first sustainability report well ahead of the mandatory requirement under the regulations, and we trust it will be useful to the readers of the report, and we would welcome comments and inputs from readers. With these remarks, I would now like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, you may press star and one to ask a question now. The first question is from the line of Vidit Shah from IIFL. Please go ahead.
Hi, thanks for taking my question. So just a couple of questions regarding margins from me. So, the FM business is now, surpassed pre-COVID levels, but the margins still remain fairly low. So is that, I mean, if you could just share the margin profile of the businesses within facilities management, and is this due to a change in mix, or are there other reasons impacting the facilities?
Devesh?
Yeah, I thought you answered that.
No, I can. Yeah, please go on.
So, if you look at the facility management business, the margins have improved both on a quarter-to-quarter basis and on a year-to-year basis. So, I'm just wondering any specific concerns that you have, Vijay?
No, so what I was asking is, let's say before COVID hit, we were doing around 6.777% margin with around 330 crores of quarterly revenue. We're back to around 360 crores of quarterly revenue, but margins are around 4.8%. So just trying to understand what is the reason for the decline versus those pre-COVID levels.
Vijay, what we've always guided is that pre-COVID level normal for SIS group is between 5.5% and 6%. And for individual businesses like FM is closer to 6%, right? We are currently tracking at 1% lower than that. A large part of that actually will come from the fact that we've done significant increments in October to December quarter. There's also been one-time catch-up pay correction payments that have happened, which are not recurring in nature. Plus, there is continuing expenditure on account of, basic COVID PPE and other things. Having said that, I believe that there is no reason why the business will not settle at same 6% ballpark, simply because there is no fundamental change in mix. In fact, the revenue mix of FM just got better with lesser exposure on IT and greater, traction coming from e-commerce and manufacturing. So I'm confident that, as the third wave and other things settle down, we will get back to that trajectory.
Okay. So in just this trajectory towards 6%, would it be a thing for 1 or 2 quarters to cover, or would it be over the next couple of years, do you see yourself getting to 6%? I mean, how do we model these things?
No, I would say that we'd still wait and watch because we don't know, third wave is still going to hang heavy on Q4. Right. So I would myself find it very hard to forecast exactly how things will play out. But the all important thing is that the gross margin line is holding steady. So there is no reduction in gross margin. So these are volume adjustments and one-off expenses, and I'm sure it will settle down as soon as things become closer to normal.
Understood. Fine. I had another question regarding the tax rate and the cash taxes paid. So, even in this quarter, and if I see the 9 months as a whole, our tax expense on the P&L has been, roughly 36 crores. However, we paid around 120 crores of cash taxes as per your net debt bridge that you all have said across the 3 quarters. And even in this quarter, the tax expense was 4 crores on the P&L, but 70 odd crores as cash taxes paid. So just trying to understand what causes this difference and how should we think about it? Is this a one-off cash tax paid, or is the cash tax generally high?
I'll take that. So I think you should look at it in 2 buckets. One is the international bucket and one is the India bucket. In the international bucket, it's a standard 30% tax which gets paid out. You don't have those things like ATJJ, etc. over there. So that gets paid as you go. It's called a pay-as-you-go tax, like an advanced tax regime we have in India. It's the same way you have in other countries also. So that's one aspect. So that's where your tax payment comes. In India, the tax payment comes because there's a mandatory TDS on all invoices raised to customers by all our businesses. So while at the end of the year, when we file our return and we take the benefits of ATJJ and other deductions, that is not reflected in the TDS rate. So the TDS is a mandatory payment which goes out to the government every year, and then you go out and claim a refund when you file your return. That is why you will find a difference between the cash payout and the tax expense in the P&L.
Sure. So this TDS is at what, 1%, 2%? That the customers deduct.
The standard rate is 2%, but you are able to make an application to the government to reduce the rate. That takes time during the year, and by the time that approval comes in, half the year is gone. And then you go out and engage with every customer and go and tell them, okay, now go and please fix this new rate to our invoice. Please fix this new rate to our invoice. In that, another 3 months goes. So we try and get some benefit out of that, but we are not able to get the full benefit because of timing issues.
Understood. So you said 2%.
2% is standard rate.
All right, got it. All right, thanks. I'll just get back to you.
Thank you. The next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Yeah, thanks. So first question for Rituraj. Rituraj, the overall demand environment, I think it looks like things are recovering quite well. And so I just wanted to kind of get your sense on the reasons behind the hike and one-time payment which you did this quarter. I understand there is a very commendable effort from the team during last 1.5 years. But is there any supply side issue which is also kind of pressurizing the availability of associates, which was behind the thought of doing this, one-time catch up from your side? Is that also a factor which is playing out?
Well, let me first clarify that we are not a staffing business and there is no associates concept here. So what I was talking about is the increments that were due to our staff. We have done increments for our non-billing staff, people who are back office, not frontline, but back office staff. Those increments happened in October. And the one-time implication there is that there was a bunch of people who did not receive pay increases in the previous year. In 2020, the higher salaried back office staff, while they didn't have any pay cuts, SIS did not do any pay cuts or any job cuts, we also were not able to give increments to the higher cost back office staff. Now those people were compensated via a one-time 1 month equivalent pay, which was paid out in Q3. So that's the one-time effect that is coming into play. As regards to supply side challenges, I don't see any. I would once again draw your attention to the fact that SIS amongst its peer set is the only company that reported a 7% revenue growth in FY21, and in FY22 9 months we are tracking close to 10% year-on-year revenue growth. So we have grown in both years, which are impacted by COVID, and this could not be possible if we had a supply side constraint of any kind.
Sure. The other question was, again, related to normalization as business comes back. I think one thing which has clearly happened, as you just mentioned, that you guys have grown during this whole crisis also. Do you think there is an element of market share gain and that can help you kind of take some bit of price hike with your clients, or do you still see very the competitive intensity remaining as strong as what it was pre-pandemic?
I think there are two fundamental issues here. First one, I'm assuming that you're comparing to the peer set when you talk about growth. The first fundamental difference is that SIS is a pure play essential services provider. Security is categorized as an essential service, so it does not get disrupted even if there's a lockdown or anything like that. Same for facility management. In fact, the demand for hygiene and sanitation services post-COVID have gone up. Per square foot expenditure on these services has gone up because of greater consciousness. Similarly, cash logistics. despite second wave, third wave, the services ought to continue as normal because that's the currency supply system of the economy. So that's the mother of all differences, that this is essential services. Therefore, its demand resilience is extremely high, and we continue to grow in crisis periods just like we grow in growth years, albeit at a lower rate. The second difference is that, post the COVID experience, several customers recognize the essential component and the fact that this is important for business continuity. When malls were shut or when, factories were operating at reduced capacity or IT parks were, operating at reduced capacity, the services that they still required to go on there was security and facility management. So they recognize that, the service provider has to be financially robust to be able to cater to that requirement and also reliable, apart from being an expert at delivering the service. And therefore, we see a natural trigger for consolidation. We see more pressure on the smaller operators who ran into some cash crisis also and who had, service continuity issues. SIS has done outstandingly well in that contrast. In fact, our January customer satisfaction survey index is 8.6, which is extremely good. And we believe that over a period of time, this will help us, towards a market consolidation. As you know that today, 65% market share is with unorganized small operators. And I think this experience of COVID will be a trigger to change that setup. But it won't happen instantly. It's not a flip of a switch. It would happen over a period of time.
So, Vikrant, sorry, let me just rephrase the question. What I was referring to was the news which were there that the global peers in the security side in India, they have been scaling back or they have not been able to retain, kind of the guards during this lockdown period in the last 1.5 years. Is that something which you are seeing on the ground and helps from a competitive point of view? Or, do you still see the same, kind of competition out there which was there pre-pandemic?
We wouldn't say that our competitors have not been able to maintain business continuity, barring the smaller ones. I think all our major competitors continue to deliver services like we do. So I don't see where your question is coming from actually.
Okay, understood. Just one clarification from Devesh. Devesh, for India security business, X of the one-off impact this quarter, the base margin comparison for Q4 will be 4.8%?
You are talking about the EBITDA margin?
The EBITDA margin.
Oh, I haven't computed separately for the standalone. You want me to get back to you separately on that?
Sure. Thanks.
Okay. I'll just note it down and get back to you.
Thank you.
Thank you. The next question is from the line of Arun Deshpande from Edelweiss. Please go ahead.
Yeah, this is Alok here from Edelweiss. Congratulations on a very good set of numbers in trying conditions, and also congratulations to the SIS team on the first sustainability report. Two questions from my side. Firstly, can you give some color on the quarter ending run rates, for all the three segments, so that's slightly easier for us to see how this quarter and next quarter may pan out?
So, Alok, thanks for that. In this, just to give you a comparable set of numbers, in September, security, facility management, and cash in India were doing 465 crores, and in December they are doing 486 crores. And if you add the international business to that, international business was, if you add all 4 businesses, including international business, in September we were run rating 857, and now we are run rating 903. But this is just a top line addition of all 4 businesses. It does not factor equity accounting on the cash side.
Okay. Rituraj, you mentioned 483 crores. That's for India securities plus cash, is it?
Let me break it down further for you. India security, just security business in India is 327.
Okay.
And just FM business in India is 127.
Okay. Okay.
Both put together is 453 for India, which in September end, this is, I'm comparing December to September. At September end it was 435.
Okay.
And now it's 453. And if you add cash to that, we are doing 486. And if you add all 4 segments, we are doing 903.
Got it. Sure. So this is quite helpful. And also, I think I just needed a little bit more color on the international segment. Reason being, this ad hoc contracts which are COVID related are now tapering down, as you had mentioned in the press release. Also, there is a mention of some events at the year end that had happened, which would have helped this quarter's revenue. Now, going forward, how should we look at it? What part of this run rate can get shaved off because of the ad hoc contracts going out, and then what part of that can get offset by the structural growth that can come in?
So ballpark, I'll give you our assessment on the Australian business, which is the mothership, the biggest chunk of the international piece. In Australia, we have close to $40 million worth of COVID-related contracts that are still continuing, and every month they will continue to reduce. Australia is now, even as they have a COVID impact right now, they are also fully vaccinated, almost fully vaccinated as a country. So we see COVID quarantine work, COVID vaccination center related work declining from $40 million to a lower number. Per annum, that is, right? And we see aviation sector, other retail sector and other such sectors, our regular clients, which had reduced our service volumes, they are adding back volumes. The universities are adding back volumes. So we see a similar scale back up of roughly $40 odd million from our existing customers. So on a net basis, we do not think that the revenue will contract majorly because COVID work going off. But it depends at the pace at which the COVID contracts come off and the speed at which the regular permanent contracts scale up back to normalcy operations. So there might be some aberrations in a quarter or two, but if you look at the entire financial year FY23, I don't see a major impact because of COVID work reducing. I think we'll make that up adequately with regular contracts. In fact,
Sure.
Our international business has won, close to $2.5 million worth of work even the last quarter.
Right. So Rituraj, overall net, that top line, which is annualized about 5,000 crores for international business, I mean, going by this quarter's run rate, of that, roughly 300 crores is what is at sort of which may taper down, and a similar number can come back net, right?
Your ballpark, you're right. Absolutely. So Alok, this is what I've been underlining quite regularly in the last 7-8 quarters. We have literally a natural hedge with international operations. When Indian operations were struggling in FY21 with severe lockdowns, etc., international business had a surge in revenue. They reported a 20% year-on-year growth. And that sort of covered ground for our growth story. This year, in the coming 12 months, we see international business reducing those one-time contracts but then Indian growth is coming back strongly. So these are very, very complementary businesses, and that's what makes the SIS story much more predictable in that sense.
Sure, absolutely. So just one more question from my side. This facility management run rate that you mentioned, see, we are above the pre-COVID levels now. So now, has the railways part of it come back to also the pre-COVID levels, or there is an upside that can come from that bit?
No, railways is about operating at close to 60-65% of pre-COVID still.
Okay, so that there is still room for that to come back, right?
There's room for comeback in IT sector, there's room for comeback in railway sector, there's room for comeback in several other subsectors. So that's what I've been saying, that as this COVID thing normalizes, what we expect is that our existing customers, certain segments that have cut back, like education, for example, schools have been shut for long periods of time. Educational establishments, IITs, IIMs, such educational establishments have also reduced quantities. This will come back strongly as and when they normalize. And similarly, there's been heightened demand from sectors like healthcare, which may see some reduction as things go back to normal. Right now, healthcare, manufacturing, etc., are on exceptionally high volumes.
Sure. Ritu, I had one more question. I don't know if there is a long queue. In that case, I may go back, but I had one more question. Can I go ahead? Or?
You may.
Operator?
Okay.
Mr. Alok, you may please go ahead, sir.
Thank you so much. Ritu, I had this question on not directly, I mean, margin is an output of the costs that are going in, obviously, but with regards to the staff vaccination, in terms of the additional costs that are going in terms of hygiene, etc. This is something which, during the pandemic has, led to our margins contracting by about 100 bips or so, roughly, in facility management, also in securities. What I wanted to ask was now, as we go forward in time and demand becomes much more normalized, the part to normalize margins, how will it work? Is it that these costs will not be there anymore, or is it that we will be able to pass this cost much more effectively to the customers?
No, I don't see the cost being passed through to customers. That's not a position we've taken from the beginning. Just for you to have the numbers, SIS has undertaken probably the largest vaccination drive in any company of our scale and size of operation. We have organized more than 450,000 doses of COVID vaccine, and all transportation, everything, arrangements that go into that, they have been taken care of at company costs. Similarly, close to 9.5 crore rupees has been paid out as COVID sort of welfare payments, because people, when they get COVID, they can't work for 10 days, 15 days, they need medical attention, they need medicines. And as a company, we've taken a call to pay them ex gratia amount. So that is another thing that is ongoing. Now, these things are not something that are intended to be passed on to customers, because this is not industry norm. Our competitors are not doing anything of this sort. They are not organizing a vaccination program or a welfare fund. So this is not, as and when the entire company gets fully vaccinated, and we are very close to that, we started a booster dose round now, but as soon as this is out of the way, which is maybe 1 or 2 quarters, and hopefully COVID is not taking up so much time, attention and cost, we believe that these costs will go out of the books. So this is not a pass-through situation at all.
Understood. Thanks, Rudraj, for all the responses, and I wish you all the best and your team for this coming quarters.
Thank you.
Thank you. Before we take the next question, a reminder to the participants: to ask a question, please press star and 1. The next question is from the line of Siddhant Mehta from B&K Securities. Please go ahead.
Yeah, hi, good afternoon. So first First of all, I wanted to talk about the days outstanding, DSO. So we have seen a slight marginal, basically DSOs are largely marginally moved up. So what's the trajectory there? Because wherever we see a strong growth, it comes with the DSOs rising. So how can you guide us on that?
Did I hear you right? You're asking about the DSO?
Yeah, DSO, days outstanding. So we are seeing days outstanding rising. So do you see it falling back again to the 60-65, or because it's rising around to 75? And in the fourth quarter last year, March, we did around the DSOs were around 68. So how do you see that?
Yeah, year-end target is always around that 65 to 70 range. That's the year-end target. And this was in this time period in the Q3. Sometimes you have businesses having the issues of the year-end and Christmas holidays. Sometimes you're able to get the collection. Sometimes you're not able to get the collection. In fact, in India Security, there were some collections which were delayed. They all came out in the first week of January as soon as the office opened. So this was just like a temporary payment timing issue, and nothing to do with any structural issues. So in the March quarter, typically we tend to target that 65 to 70 day range, and we think we'll get there.
Same for the facility management also? Because that was around 80-85. Yeah, that was around 80-85. So and we have seen a consistent fall over a period of time. So do you expect it to fall further?
Well, our focus is on getting the cash out from the customers, so that focus continues. How much it will fall or whether it stays stable is difficult to say, but definitely we will not allow it to go out of hand out of this level.
And my last question is, as earlier you have talked about facilities management margins, which tend to move, which will go around 6% in few times to come after all these expenses and everything, one-off expenses go away. Same with India Security, when do you expect the 6% margin mark so that you can achieve that 6% margin? How much time will it take? Just wanted to know that.
Like I said, we are eagerly waiting for all these exceptional costs related to COVID to go out, and also our regular volumes from existing customers to come back. It's very hard to predict when that is going to happen. Like, for example, we had no clue that we'll have to tackle a third wave and a booster dose. So, it's very hard for us to forecast whether that's a 1 quarter issue or a more than 1 quarter issue. But I think I'll again draw your attention to the fact that the gross margin in security, like FM, remains unchanged. The gross margin line is intact. It's not as if customers are reducing prices or something. So we are therefore confident that we will be able to go back to the pre-COVID levels.
Thank you so much.
Thank you. The next question is from the line of Rohan, an individual investor. Please go ahead.
Hello, sir. My name is Rohan, and I just have three questions. First is regarding the margin, second is regarding the market share, and third is technology. So I just want to know what is SIS doing uniquely compared to its peers in improving these three stuff.
What are the three things, my friend? You said margin, I think.
Share, margins, and in terms of technology, because technology, so these three things, first of all.
Okay, so I think we've adequately answered the margin question. Security, facility management, cash logistics type businesses globally, if you look at the peer group, other listed companies world over, in our segment, they are operating ballpark 5.5-6% EBITDA margin line. We were at 5.5-6% pre-COVID. We have slipped because of reasons I have explained already, and we are very hopeful to go back to 5.5-6% margin. But this I would like to underline that security, FM and cash logistics are, on a combined basis are not double-digit EBITDA margin businesses. So you have to take that into account that this is a ballpark 6% type industry. What is exciting about this industry is that even at a 6% EBITDA margin, this industry has capacity to deliver more than 20% return on capital employed and more than 20% return on equity. Ultimately, that's the beauty of the industry. And if you see our ROCE line for the last 4 or 5 years since we got listed, you will see that we have been oscillating around the 20% mark, give or take few percent here and there. Including the COVID period, our ROCE has been very, very strong. As regards to market share, our Vision 2025 revolves around 2 basic themes. 1, building on market share, and 2, building on solutioning. So as far as market share is concerned, we are a believer that the Indian industry will see a fundamental change over the next 3-4 years as labor reforms get implemented. As labor reforms get implemented, there will be a more level playing field. Customers will prefer to operate with larger, financially more stable and more compliance-oriented service providers. And that will change the industry mix. Today, organized players like ourselves have only 35% as addressable market. 65% is taken care of by, regional players, local players, and smaller unorganized players. Over a period of 4 or 5 years, I see this mix changing. More than half of the market will be addressed by large organized players, and that will open up the addressable market size for us. So we are very bullish that we have the opportunity to double our market share in security, double our market share in FM, and double our market share in cash logistics in the next 3 to 4 years. As regards to technology, SIS has been a pioneer in implementing technology both at the back end for our own internal efficiency, whether it is implementing Oracle or implementing facial recognition based attendance software or IOPS for operation management, mobile based training platforms where people can self-learn. We've done a whole lot of work around technology at the back end. Similarly, we are doing a whole lot of technology-related work on the customer end. You'll be very pleased to know that our latest business, We Protect, which is an alarm monitoring company. It does not provide security guards. It provides alarms and does monitoring of customer sites remotely using CCTV footage. That business has crossed 5,000 connections this quarter, which is a great signal, and we are working more and more to build new technology-based products in our FM business like energy management, like One SIS solutions, and in our cash business with PEGA and other such services. So we are looking very aggressively to enhance our service offering and use more and more technology, my friend. I hope that's a longish answer, but I hope I have addressed some of your concerns.
Yes, sir, you have addressed all the concerns. Thank you for that. Because I also think that when we use technology, we can exponentially grow the business compared to, because whenever we think SIS or any company, we think that it's a capital intensive business, and whenever we need to grow, there will be a physical growth, like there will be people involved in that. So that's why I think that when we use technology, I guess there will be a huge growth, and that will be an exponential growth. So that's why I asked it. So thank you for your long answer. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore. Please go ahead.
Hi, good afternoon, Rituraj and Devesh. Great set of numbers for the December quarter. So I had one question. In the last 2 years, you've been kind of talking about improvement in market share through inorganic, maybe as an opportunity, looking at the environment where a lot of the small and medium-sized players were struggling to get through the tough times, constrained cash flows, and so on and so forth. But we didn't really do anything. So is it because now you feel more confident that organic growth is a better way, a better quality growth path, or were the pricing expectations from potential candidates were completely haywire? I mean, I was just curious to understand what happened.
Well, thanks for that, Ashwini. I think SIS has always been a organic-led growth story. We have always believed that that's the best way to create value and maintain our return profile that we want to maintain, 20% plus. We have acquired companies in the past. We continue to look at opportunities, but in the last 2 years, we've been preoccupied in settling the transactions that were half closed. Like this quarter, for example, Ashwini, if you've seen, we have closed the P4G New Zealand transaction. We acquired the remainder shareholding there. And that's a beautiful story where we bought a very small $8 million business, and today it's almost run rating close to $25-30 million over a cycle of 3 years. So the return profile on that business is absolutely fantastic. It's a 20% plus IRR for us. So we will look at doing acquisitions. Our acquisitions predominantly will be India-focused, but we will also be looking at transactions which are very value-accretive for us, and we will have to wait for the expectations to settle down. There have been several IPOs in our sector of late, Ashwini, and several other IPOs are being lined up. So obviously at this point in time, people who can IPO are looking at completely different level of multiples, which we believe are unviable for us to even contemplate. And, I'm sure that in near term, there will be a period of time where people who have attempted to IPO and they cannot IPO, they will definitely be on the block, and that's when we hope to make our move.
Okay. Great. Thanks for that. The other thing is that, one of the drivers for your top line, especially in the security business, is how the minimum wage regulation moves in, different states. Could you provide some update as to what's happening there? There's a huge amount of, I would say, economic distress on the lower leg of this K-shaped recovery. And unfortunately, the urban bottom of the pyramid workers and rural India has seen a brunt of that. In that context, I was a little surprised that the government didn't provide for more support by way of consumption. But is wage an area, I wonder if the government's looking at it or state government's thinking about it? I mean, what are you hearing?
Well, I'm glad you asked that question because, when we say 20% plus growth, Ashwini, that 20% growth generally is broken down into three components. Roughly 7-8% around about came from minimum wage inflation.
Yeah.
And the remainder 12% came from existing customer new business and new customer acquisition.
Yeah.
Now, in the last 2 years, what we witnessed is that the minimum wage escalation has completely stalled. The minimum wage escalation that came through for the central minimum wage was barely 1.5%, as against 8 to 10%. So that has been a problem. While we've acquired customers to make up as much as we could, we believe that the minimum wage inflation is a key element of our growth story, and it has been for the last many years. And that's not just unique to us; that's an industry-wide global phenomena. But looking at it from a different perspective, Ashwini, I see also that there is a massive catch-up that is building. Government hasn't really done anything much for the minimum wage paid workers in the last year and a half, 2 years because of the state of the economy. But today, as the economy is looking at, a 9% growth this year and an 8.5% growth next year, sooner than later, I guess there will be, significant pressure to do something major on the minimum wage side. And I guess that is going to be a mega opportunity for SIS.
So, sorry, pardon the ignorance on this. Is that kind of centrally mandated or is centrally advised and then each state passes its own law? How does it work?
Well, the way it works is that, so far the way it has worked is that the central government generally does central minimum wage related hike and the state governments do their own hikes.
Okay.
But they all sort of lean on each other's percentage of hike given. Right? So if it's subdued, then it's going to be subdued across the country, central and state. So I guess there will be catch up hopefully soon enough in that direction. And if the labor reforms wage code gets implemented sooner, I think the act is there since last year and a half. They are yet to announce the implementation schedule. But if and when that gets implemented, Ashwini, that is also talking about a national floor minimum wage,
correct,
which basically provides a framework for connecting the central wage and the state wages, like a floor wage for the whole country. So as and when that floor wage comes, that could be another booster. But I see these two things as different. Even if the floor wage does not come or it comes at a lower level, the minimum wage catch-up has to come. So I'm banking more on the minimum wage catch-up that hasn't happened across India for the last year and a half, 2 years. And then, the national floor wage could be a sort of a booster on top of that.
And what's the reason? I mean, I'm sure you've been in touch with various government ministries that take these decisions. I mean, what's their kind of explanation? They just don't want to put burden on industry in a tough time, or?
Yeah, absolutely. I think, the government's clearly trying to do more, reducing taxes, incentivizing production. They don't want to do anything to upset the apple cart in terms of additional costs. One of the things that labor reforms entails is higher cost to employer. Right? And therefore, I think the government is a little wary of, bringing that out unless the general sentiment in the economy is favorable and, amenable to that idea.
Right.
In fact, we completely believe, Ashwini, that it should only happen, even if it happened 2 quarters late, it should only happen when the industry sentiment is favorable, because we don't want to get into fist fight with our customers to pass it through. Right? Industry uptake has to be high so that the pass-through is automatic.
Yeah, no, that's fair. That's fair. And finally, congratulations on the wonderful recognition from the Prime Minister's office. And all the best.
Thank you very much. Thank you.
Thank you. The next question is from the line of Shalabh Agarwal from Snowball Capital. Please go ahead.
Good afternoon, and sir, thank you for taking my question. So the first question is, I wanted to check about this segment of residential apartment security. Is that a big business for us, or are we really looking at it? And how are we making inroads into this business, because this is a stronghold of players like JLLs of the world?
Well, Residential Welfare Association or residential security is not a primary focus market for SIS per se. And the reason for that is basically because, it's more addressed by the lower cost operators. However, we do certain high-end societies, which are generally managed directly where the impetus is not just on the lowest cost provider, but also on the quality of service. So in Gurgaon, you would have some Aralyas and Magnolias and, top-end residential accommodation like that, or in Bangalore, you would have certain facilities. But barring that, we are not either very big or very super bullish on the RWA segment.
Okay. So in these high-end societies, is it like provided directly by us, or we get it? We work with JLLs of the world to get the contract, because they typically get the contract and they would outsource.
In certain instances, they may be direct contracts, but in most instances, it's basically the customer going through a JLL or a CBRE or a Colliers, but mandating that their security provider will be SIS, or their facility management must be done by DTSS.
Okay. So this is not a segment which one SIS is targeting?
One SIS is primarily, as of right now, targeting manufacturing,
okay,
healthcare, and commercial establishments.
Okay.
Like an IT park or a mall or something like that.
Okay. And sir, just to touch upon one SIS, can you also let us know where we are on our journey and how big is that component in our overall scheme of things?
Well, one SIS is very recent as a development. It was an idea that we were cultivating as a part of our Vision 2025. It's still fairly small. We barely have a 5-7 people team that started it. Now it's gaining momentum. We are winning more contracts. We are partnering with some of the large commercial real estate owners. They love the idea that unlike a large IPC, property managers, we are not going to take the contract and then outsource everything. We are talking about self-delivery. We are also adding a technology component, energy management, dashboards for customers to see service fulfillment. So I think there's a lot of exciting things on one SIS, and it's one of our big funds in our Vision 2025 plan. But for it to really take a material size, I guess it's at least a year or two away.
Sure. Thank you, Rituraj, and all the very best.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you very much, everybody, for participating and also asking all your questions. I hope we've been able to address them satisfactorily. This third quarter has been a remarkable quarter for SIS. It signals a strong growth coming back. Looking at the order pipeline, Q4 again looks like an interesting quarter for all 4 segments: security in India and international, facility management and cash logistics. We are also very encouraged by the budget. We believe that India's commitment to spend 5 lakh crore last year and 7.5 lakh crore in the current year towards infrastructure creation is a massive opportunity creation for us, because whether it's building a metro or a healthcare establishment or educational establishment or a railway platform, everything, any kind of infrastructure, any kind of square footage that is added is going to need CCTV cameras, security staff, and hygiene and sanitation staff. So effectively, we see this as addressable market expansion, and it's a really wonderful and encouraging news for us. I also believe that certain developments in the market augur very well for SIS, particularly the listing of certain competitors in the cash logistics space. Even as SIS is the second largest cash logistics company in the country, our cash logistics business has honestly not received true recognition or value because it happens to be the smallest amongst the four segments that we operate. But, with other cash companies getting listed, we are very hopeful that the market will take note of our cash business that is not just continuing to grow, it is also run rating a 500 crore ballpark revenue and a 12-13% EBITDA margin. So on a standalone basis, just the cash business is worth significant value, which is currently not fully captured in the SIS story. So we are very encouraged by the macro environment and also the stock environment and the order pipeline, and we hope to close this financial year FY22 despite the first quarter, April, May, June, getting literally wiped out because of second wave of COVID, and Q4 again, Jan, Feb seem to have significant COVID third wave impact. Despite 4-5 months of disruption in this FY22, we are very hopeful to close near to 10%, near to double-digit revenue growth. And I think that is a testimony to the power of essential services and the platform that SIS has created as a unique platform, which is not just a market leader in security, but also a market leader in facility management and cash logistics segments. So thank you very much once again for your patience, and I look forward to speaking to you sometime in the near future. Please take care. Thank you. Bye-bye.
Thank you. On behalf of SIS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.